In a market that feels like a roller coaster these days, just about every investor is asking the same thing. Where can I find reliable, growing income? And one name just keeps popping up over and over again. I'm talking about the Schwab U.S. Dividend Equity ETF, or as pretty much everyone calls it, SCHD. It's a total rock star in the dividend world, but, popularity doesn't automatically make it a smart investment. So let's dig in and find out what's really going on.
So yeah, that's really the big question we need to answer today. I mean, with its recent performance kind of lagging the rest of the market, we've got to pop the hood on this thing. We need to figure out if SCHD's legendary strategy, the one everyone talks about, still actually works. Are we looking at a golden opportunity to buy some real quality on sale? Or is this a red flag, a sign of some bigger problems?
All right, so here's how we're going to get to the bottom of this. First, we'll break down the strategy that makes SCHD so special. Then, we'll crunch the numbers that really matter. After that, we'll check out its valuation, and then the final verdict. And to wrap it all up, we'll see how it stacks up against some of the other big players out there.
Okay, let's get right into it. The strategy. This is really the secret sauce of SCHD. If you want to understand this ETF, you absolutely have to know what makes it tick, the specific rule-based system it follows. Trust me, this is not just about chasing the highest dividend yields, it's way, way smarter than that.
So what SCHD does is it tracks this thing called the Dow Jones U.S. Dividend 100 Index. And the key words you need to remember are fundamental strength. See, the whole point of this index is to avoid what we call yield traps. You've seen them, right? Those companies with a super tempting, high dividend yield that looks amazing, but it's built on a shaky foundation and is probably going to get cut. This index is designed to sniff those out and avoid them. And how does it do that? Well, this is the really cool part. It's a multi-step process. First, it only looks at companies that have paid a dividend for at least 10 years straight. That's the first cut. Then, from that already solid group, it ranks them using a combined score based on these 4 factors right here: cash flow, profitability, yield, and dividend growth. It's like a super strict bouncer for a portfolio. Only the absolute strongest, most financially sound companies get in. All the weaker ones get kicked to the curb.
So what do you get after that intense screening process? Well, you get a portfolio that looks very intentional. You can see it's heavily weighted in these classic value and defensive sectors. We're talking energy, consumer defensive, healthcare. But what's maybe even more important is what you don't see a lot of. It's got way less of the high-flying tech stocks compared to something like the S&P 500, and make no mistake, that is 100% on purpose.
But that specific design comes with a trade-off. And that brings us to, well, the elephant in the room. Its recent performance. I mean, let's just put the numbers out there. Over the past year, the S&P 500 shot up over 14%. SCHD, it returned just over 2%. That huge gap is without a doubt the number one thing on everyone's mind when they look at this fund right now.
And really, that performance perfectly highlights the 2 biggest risks you have to be comfortable with if you own SCHD. First, because of its focus on value and quality, it's pretty much guaranteed to lag behind when high-growth tech stocks are on a tear. That's just part of the deal. And second, with nearly 20% of the fund in energy, you're also taking on some risk tied to the wild swings of oil and gas prices.
All right, so let's switch gears and look at the numbers, because despite those short-term performance issues, this is where we get to see the case for SCHD's long-term health. This is where we find out if that fancy screening process is actually doing its job and delivering real quality.
First up, let's talk dividend growth. Look, a nice starting yield is great, but if that dividend payment isn't growing year after year, inflation is just going to eat it for lunch. Think of dividend growth as your investment giving you a pay raise every single year without you having to ask. It's what keeps your income stream ahead of rising prices.
And on this front, SCHD absolutely delivers. Over the past 5 years, its dividend has grown at an annual rate of 7.33%. That is a fantastic number. It means your income from this fund has been growing comfortably faster than inflation. For anyone investing for income, this isn't just a nice-to-have, it's absolutely essential.
Okay, next up, return on equity, or ROE. This is one of my favorite ways to measure a company's quality. The easiest way to think about it is like a report card for the management team. It basically asks, how good are you at taking our money, the shareholders' money, and turning it into real profit? And just like in school, a higher grade is always better.
And check this out. This number right here is maybe the best proof that SCHD's quality screening works. The average ROE for the companies in the fund is a whopping 28.71%. Let me be clear. That isn't just good, it's flat out exceptional.
It tells you that this ETF is filled with incredibly profitable, incredibly efficient, profit-generating machines.
And last but definitely not least, let's talk about cost. Every fund charges an annual fee, the expense ratio. And I know it can seem like a tiny, insignificant number, but trust me, over 10, 20, 30 years, fees are like a silent killer of returns. Even a tiny difference can add up to tens of thousands of dollars that should be in your pocket, not someone else's.
And this is another huge win for SCHD. It is incredibly cheap. The expense ratio is just 0.06%. That's one of the absolute lowest you're going to find. It's a huge permanent advantage that means more of your money is always working for you instead of paying fees.
Okay, quick recap. We've established that the portfolio is absolutely packed with high-quality, super profitable companies. But as any good investor knows, even the best quality isn't a good deal if you overpay for it. So now we have to ask the critical question, is SCHD trading at a fair price today?
So if we look at some key valuation numbers, its price-to-earnings ratio, or PE, is right in line with its peers. Pretty competitive. But here's where it gets really interesting. Look at the price to cash flow. It's actually trading at a discount to the average. And that makes total sense, right? For a fund that is obsessed with cash flow in its screening process, this is the metric you want to see looking good. It tells you you're not overpaying for all that cash generation.
And honestly, this quote just nails it. It really sums up the entire thesis. The whole idea behind SCHD is high quality at a reasonable price. That's it. You're getting this basket of superior, profitable companies, but you're getting them at a fair valuation.
All right, this brings us to the moment of truth. We've looked at the strategy, we've crunched the numbers, we've talked about the risks, and we've checked the price tag. It is time to put all the pieces together and make the final call.
So, after all of that, after seeing the recent slump, but also seeing the undeniable quality underneath, what's the final verdict? Is SCHD a buy, a hold, or a sell right now?
Our verdict is a buy. But let's be really clear about this. This is a buy, but for a specific kind of investor. We're talking about someone with a long-term view who's focused on that reliable, growing income stream. So, with that in mind, based on the portfolio's quality and fair price, our rating is a buy with a 12-month price target of $88 per share. The single best reason? You get an elite portfolio with a great growing dividend, and it costs you almost nothing. And the biggest risk? Simple. If growth stocks keep crushing it, SCHD will likely continue to underperform. You have to be okay with that possibility.
Of course, SCHD isn't the only game in town. It doesn't exist in a vacuum, so it's super important to see how it compares to some of its biggest rivals. That's how you figure out if it's really the best fit for your portfolio. So, here's a quick look at the competition. If your main goal is just pure dividend growth, you want that paycheck to grow as fast as possible, then VIG is probably your best bet, but you'll start with a lower yield. On the other hand, if you want the absolute highest yield you can get today, and you're cool with a bit more risk, then SPYD is designed for you. And SCHD, it sits right in that perfect sweet spot, giving you a great balance of current yield, quality, and growth. Which one is best really comes down to what you're looking for.
At the end of the day, SCHD is all about playing the long game. Its whole strategy is built on timeless qualities like profitability and financial strength. The big question is that the right approach for the market we're heading into? I'd love to know what you think. Drop a comment below and let me know. And while you're there, tell us what ETF or stock we should analyze next. And hey, don't forget to subscribe. Thanks for joining me.